In the last video that we talked about how to consolidate two companies' balance sheet. And in this video, we want to talk about how to consolidate two companies' income statement. And we are given by the case. Here the question is saying that Helios is planning to acquire Luna Limited and wants to understand what a pro forma income statement might look like for the next 12 months. So we know the transaction will be funded with 100 million of balance sheet cash and debt issuance of 1,200 million and an equity issuance of 700 million. And forecast interest rates are 6% for new debt and 1.5% for cash. And we also know that the company will also has SG&A synergies, and it is expected to be 25 millions per annum. And the deal goodwill is expected to be 720 million. The tax rate is 30%. Now, I want to point out that there are some figures actually is irrelevant to the income statement calculation. For example, like deal goodwill, we know that is going to the balance sheet and also the equity issuance as well. Right. So also there's some points that, for example, a transaction will be funded by 100 million of balance sheet cash, then we will know if the company, the purchaser, the Helios, they're going to use 100 million of balance sheet cash. That being said, they need to sacrifice the interest income, right? Because they have 100 million of dollars in a bank account or 100 million dollars in another accounts like market security. Let's say they can receive the interest if they don't do anything with that cash, right? But because they use $100 million to acquire Luna Limited, so they will sacrifice the interest income, right? And also another thing is the debt issuance. They issue $1,200 million debt, and we know that going to increase their expense, the interest expense from the new debt, right? So that being said, we will see the situation where the interest income is lower and the interest expense is higher, right? Both gonna affect the profit at the end. And if the profit are being affected by these two effects, then we know their tax expense will be lower, right? Because profit is lower, so that being said, you can pay less tax, right? Now, with this logic, we can build our pro forma income statement when the Helios is planning to acquire Luna Limited. So first, I want to type the synergy. The synergy basically is a cost saving. So we know they have SG&A synergy for $25 million per annum. So that being said, it's a cost saving. It's like, for example, let's say the two companies have accounting department, and then Helios had one, Luna has one as well. But when they've been merged together, they actually can lay off people, they can cut the costs. They don't really need two accounting teams to deal with companies' accounting stuff, right? So they can save up the money from this deal, right? After they've been merged together. So that being said, it is a negative number here. So it's a cost saving. That's the reason why I said that. So I can type 25, but make it as a negative one. So it's 25 millions. Because SG&A has been lowered, right? It's lower right now. That will affect the profit, meaning you are making more money because expense right now is lower, so it's more profit. Now, because of the higher profit, you need to pay more tax because you earn more. So that being said, the 25 should times the tax rate for 30%, and we know the tax rate is 30% here. Now times 30%, and I also want to make it to times -1 because it can become a positive number, but it's still being deducted when we want to calculate the net income. Anyway, here's the financing. Now we know the companies is using 100 million balance sheet cash. So that should be 100 times the expected interest rate, forecast interest rate for 1.5% for cash, right? And I want to make it as a negative because now the interest income is lower. And interest expense, they issue new debt for 1,200 million. So 1,200 times 6%, right? That's 72. Okay, that's financing. That's for the debt. Now one is down, one is up. They are both gonna affect the profit because interest income is lower right now and interest expense is higher. Your profits will be lower, right? Because your profits will be lower, so you pay less tax. So I want to sum up these two, and I want to times 30%. And that's your tax expense, and make it as a -1. You pay lower tax because you earn less, right? Now we can combine them together. I can combine the sales, cost of goods sold, SG&A, interest income, interest expense, tax expense. And I copy the formula here, gross profit, and then operating profit, profit before tax, and that's your final net income of the consolidated income statement, right? And in this case, we just assume that the deal will be closed at the end of the year, right? So the company is forecasting the pro forma income statement. They want to know how does it look like for the next 12 months. But what if we are running to the situation where we want to see where the company acquired, where the deal is closed at the end of the August? Okay, well, how are we going to do? Well, then at the time, we need to understand the stub period. So here's the next question. We know that Helios bought 100% of the Luna Limited, and the deal will be closed at August 31st. Okay. Helios reports on the December year end, and the transaction basically are the same, right? They use cash, they issue debt, they issue equity. Interest rate are the same as the previous one as well. 6% for new debt, 1.5% for cash. SG&A synergy are the same as well. The only difference here is the closing date, right? Now, because of that, we need to understand the stub period. So a stub period is the abbreviated slice of a fiscal year that runs from a transaction's closing date to the next reporting date. So in M&A accounting, if you close on August 31st, your stub period is September 1st through December 31st. So only those 4 months are in scope for that year's consolidated results. And why stub periods matter in consolidation? You prepare and report financials just for that interim span, known as stub period financial statement, and parade revenues, expenses, synergies, and interest to reflect only the months you actually own the target. So in this case, Helios, they purchase Luna and the deal will be closed on August 31st. So that being said, the previous figures, like from January to August, they don't really belong to Helios, right? The figures, the income statement of Luna, they didn't belong to Helios. The only periods that Luna's income statement that belong to Helio is after the acquisition. right? So this ensures, if we want to calculate a portion of the Luna's income statement, this ensures you don't recognize benefit or costs for periods before acquisition, right? That being said, we need to calculate the stub period, okay? So stub period of the Luna. So I will use Luna income statement to times 4/12. So why is 4/12? Well, because like I said, January to August, the figures are not belong to Helios. After that, after the acquisition, yes, the Luna's income statement figures belong to Helios, right? So after August, we know it's September, October, November, and December. So it's 4/12 months, right? So I copy and paste for the Lunas for the next 4 months. Now we can do the same thing like we did for the previous question. So now synergies, we know the cost savings from SG&A, 25, right? But it's per annum. Remember, this is per annum. You still need to calculate a portion of that. So it's 25 times 4/12 times -1, because it's cost saving, so it's negative numbers. Because you save the money from the acquisition, from the merging, you increase your profit as well. Because the profit has been increased, you pay more tax, right? So 8.3 times 30% times negative. I will make it as a positive figures. And for financing, still the same, that they're gonna use 100 million of balance sheet cash. And we know the interest rate is 1.5% for cash, but it's annual interest rate, right? So times 4/12 times -1, make it as a negative numbers. Interest expense is 1,200 times 6%. That's interest expense, and you times the portion, right? That's 24. So interest income lower and interest expense is higher. That ultimately affects the profit. Profit has been affected, tax can be paid less, right? %30 times -1, right? And now we can calculate the combo, the consolidated income statement. So you only include the synergy, financing, and stub period, and Helios, right? Because Luna's figures, they are annual, right? And you need proportion of that. So the gross profit, and then the interest income, operating profit, profit before tax, and then the final net income. And this is your consolidated income statement when the deal is closing during the years. I hope this helps, and I'll see you in the next video.